So using KT&G as our example for dividend discount model, so here we have some information necessary, okay? Last year, time point zero, okay? EPS, let's say it was 41.57 per share, Korean won unit, by the way. Dividend 3,200 Korean won per share. ROE was 15%. EPS grew by 15% until last year, okay? And then going into the future, we need some assumptions, okay? History is history, future is future. But let's see. Current payout ratio will be sustained in the future forever. Why? Because it's already a stable business, okay? KT&G, right? People keep on smoking, and then once they ruin their health, they eat ginseng to live long, and then 병 주고 약 주고, it's like a bad thing for your health as well as good thing for your health as well. So stable business, let's assume that. And then ROE is expected to be 13% in the future. And ROE was slightly better, but let's say it's going to be a bit slower, maybe because the health concern of the people increases. Beta, okay, it's 0.5 because people keep on consuming, so it's less sensitive to the market, beta being less than 1. And Korea's treasury rate, risk-free rate, is double A only, so 2.58%. Given that this is not AAA country, we have to consider the default spread, 8 basis points, and then equity risk premium, 6% is assumed. Now, we have to think about the timeline because this is valuation going into the future, and what's time point 0, and then where is time point 1, and then where do we stand? You may be concerned about it, especially the accounting report, 10K or annual report, gets published every year, and that publication is not the same as the fiscal year end. Fiscal year end in Korea mostly is December 31st every calendar year. Okay, it goes together with calendar year in Korea. But they do audit, okay? Your friends, you like accounting, CPA, I love CPAs too. And then CPAs work busily in January until March, like crazily working hard. Why? Because after the finishing of a fiscal year at December 31st, from January 1st, all the CPAs, auditing firms have to work diligently to make sure those accounting reports, annual reports are correct and not mistaken. Okay, no manipulation is going on. And they do audit, we call it. And then that auditing process finishes until like February or early March. And then the annual report gets published in March time or sometime in the spring. Okay, by the time you receive it and then know about the information, already 3 or 4 months are passed. And also thinking about this semester right now, this is May time, and thinking about your I-Core project, which is going to be in your end of May, then you may wonder, oh my God, it's already 5 months past since December 31st, okay, last fiscal year, time 0. And then the time 1, okay, this fiscal year end is December, only 7 months left. You may wonder. And then here, I gave you the information about last year. And then the future, going into the future, the assumptions were thrown out. Then use the dividend discount model. You are standing over here in this time horizon, okay, time 0 and 1 and 2 and 3 and 4. Now, you may question, it's already May. Last fiscal year ended 5 months ago. Don't I need to be razor sharp in computing the value of the company right now? Okay. Wouldn't the 5 months make much difference? So much so that I want to update the accounting report over this 5 months period so that whatever I do would be 12 months basis from this time on. But don't worry, okay? My answer, no. Get some life, okay? 인생 너무 힘들게 살지 마세요. Okay, just you are doing the baby step. Okay, don't try to be too perfect. You know, um, just make sure you do the baby step correctly. Okay, work with annual data. Assume as if you are on January 1st. Okay, work with January 1st or December 31st data. Okay, um, and annual data is just good enough. Okay, in any case, you are estimating with error, and then you can do such detailed adjustments in more advanced courses. So this is just intermediate corporate finance, not advanced corporate finance. Okay, advanced corporate finance, you would have to do like updating, a quarterly updating. Okay, the accounting report, okay, non-audited accounting report gets published every quarter. So the first quarter, which is like January, February, March, okay, 3 months performance, they get reported at the end of April. Okay, so you can do quarterly updating. Okay, so updated information for the 3 months, and then just you have to forecast 3 months forward. Still you have 1 or 2 months mismatch. Okay, this April data, we don't have it. May data, hell no, we don't have it. Okay, so you will be imperfect in updating anyway. We are estimating with errors anyway. What difference would that 3 months make? No, this is a stable business anyway. And just do your baby step nicely. Okay, treat yourself okay. Okay, get some life. Um, that's it. And then, so just work with annual data and then estimate it. What matters is the expected numbers, and then the normal business situation is assumed, and then expected payout ratio will be about 7%. And then that's based on your historical data of what is it? Dividend payment amount divided by EPS, right? Dividend per share, and then EPS, earnings per share. Okay, out of your net income per share, how much did the company pay as a dividend? And that's a payout ratio. And we assume it to be sustained. And then the expected EPS growth rate, we will have to think about it. Okay, so payout ratio is fixed, but what's the EPS growth rate? Okay, let's go. So earnings growth rate, it boils down to net income growth rate, because whatever net income that we get, we will apply the payout ratio, 77%. Okay, so what is the growth rate of net income will be our question over here. So growth rate of earnings depends on how much you reinvest and how much return you generate from the reinvestment. Okay, so growth comes from your reinvestment. Okay, that's the idea. So growth rate, we can analyze it to be a composition of reinvestment rate and the rate of return for your investment. Okay, rate of return. So you multiply these two. Okay, percentage reinvestment and percent return. When the percent of return is stable, what can you do? Well, growth rate of net income will be retention rate times return on equity. So ROE is percentage return. Okay, in equity holders' perspective, this is the rate of return, ROE. And then the whatever was reinvested, that's what we call the retention rate. So you multiply these two, it will be your growth rate of net income, growth rate of EPS as well, assuming that the number of shares outstanding does not change. Okay, so that's when we do dividend discount model or free cash flow to equity model. Okay, here you want to estimate the growth rate of your net income. How about when you want to do free cash flow to firm method? Well, there you will have to think about the growth rate of after-tax EBIT. Okay, we call it NOPAT, no net operating profit after tax. Growth rate of this operating income, how much is it? Well, your reinvestment rate times ROC will be the formula for that. When we assume stable growth. Okay, the expected growth rate in earnings for a company cannot exceed its return on equity in the long term. So that's the idea. Okay, you cannot grow more than your reinvestment. Okay, so retention rate or reinvestment rate times ROE or ROC. Typically, this ROE or ROC are way lower than 100%. So your growth rate cannot be higher than your retention rate or higher than your reinvestment rate, typically, okay, in a stable stage. So that's the idea. So that's the first situation when the percentage of return is stable. But there are some situations when the percentage of return changes over time, okay? But for this part, please wait until our second encounter of this, okay? So when the percentage of return is stable, okay, here's the idea. Numerical example, ROE is assumed to be 12%. Then the first period, well, let's see, equity in existing project is, let's assume it to be $1,000, and out of it, your ROE is 12%. Then what should be your earnings? Well, just multiply these two, 1,000 times 12%, that's going to be current earnings of $120. And then out of 100 of current earnings, 120 is reinvested. And then retention ratio, in that case, well, would be 83.33%. So in the second stage, right, equity in the existing project is 1,000, and then you reinvest 100 out of this current earnings, okay, next period, and you still generate 12% return out of your investment. So you have to apply ROE of 12% for both existing project and new project, 12%, 12%. And then how much net income would you generate out of this investment? Well, 120 for the existing project and then $12 for the new investment. So in aggregate, it will be $132 earnings next period. So what's the change in earnings? Well, next period's earnings minus current earnings, 2 minus 1, okay, equation 2 minus equation 1, that is going to be these two multiplications, and then you will realize, well, these these green, what is it, ROE part, right? It cancels out, so this is going to be 0. And what is remaining will be this orange box times 12% ROE. That is the return. The growth comes from your ROE from your new investment. Your growth comes from your new investment times ROE. $100 times 12%. So change in earnings is going to be $12, right? So it's, if you look at the right-hand side of the equation, things get clearer. 132, it was your recent period one. The previous period was 120, so the difference is $12. This is the growth in your net income, okay? So growth in earnings should be your change in earnings over current earnings, which is 12 over 120. Okay, so this is $12. Where is my mouse? Right, $12 over 120. Okay, current earnings. So that is going to be 10%. Or you can see that 10% growth should be ROE of 12% times retention ratio of 83.33%, which is 10%. Okay, so your growth comes from the reinvestment times ROE. Okay, so that's going to be your simple analysis of your growth. Dividend discount model. Okay, so the value will be your cash flow next year divided by R minus G in a golden growth model. And then the cash flow number one, next year cash flow will be expected dividend next year. Okay, and that has to do with your expected payout ratio. And then the R comes from capital asset pricing model that we worked with before. Now, growth rate, the most difficult part of valuation is this one. Growth rate should be reinvestment rate times ROE in equity cash flow method, dividend discount model, or FCFE. Okay, remember this is the only one, the of the many ways of projecting growth rate, this is using economic fundamental relations. Okay, so this is not the only one. Okay, this is only one of the many. Okay, many ways of estimating growth rate, but it is deeply related to this method is deeply rooted in the fundamentals variables. Reinvestment rate related ratio in dividend discount model, it should be retention ratio being equal to 1 minus payout ratio, and then expected ROE should be defined as net income divided by book value of equity, okay, in the beginning of the period. Of course, there are, at least two different ways of estimating ROE. I just proposed one way of doing it. So net income of this period divided by beginning of the period, beginning balance of book value of equity. The other way of calculating ROE is the net income divided by average book value of equity, average of beginning balance and the ending balance, right? Because book value of equity comes from balance sheet, which is the snapshot figure, whereas net income is a video kind of flow concept over a period. So beginning and ending period, averaging it could be another way of calculating ROE. But anyway, for mathematical convenience, I just work with the beginning of the period, okay? Book value of equity. Anyway, doesn't matter. ROE measures how much net income does each dollar of does a dollar of equity investment generate. The more return you want for a given amount of investment, and then hence it is a measure of management efficiency. So how well does your CEO work? Okay, look at the ROE is the idea. It really depends on the ability of the top management team, i.e. the CEO, high ability, then high ROE is quite natural. And then in this example, we will just take ROE as given, KT&G. Another way of saying the CEO will not change, okay? Or board of directors will have no change in strategic direction, okay? What matters is the expected numbers, right? Normal business situation, expected payout ratio, about 7%, and then expected EPS growth rate should be expected retention ratio times expected ROE. So 1 minus 77% times 13% ROE, that gives me about 3% growth rate. And cost of equity using CAPM, right? Remember, the Korea's bond rate was 2.58%, but it's double A only. It's not risk-free. So we subtract the default spread of Korea, 8 basis points out of it. So that's going to be 2.5%. And plus beta of 0.5 times equity risk premium, 6%. That gives me 5.5% of cost of equity. Cost of equity. Then what should be the fair value per share of KT&G? That is, well, 131,451 Korean won per share using golden growth model. So the numerator goes like 4157 times 1 plus growth rate and times retention ratio of what is it? The 77% divided by R 5.5% minus G being 3%. Okay, so that's how we estimate using dividend discount model. Dividend and cash flow to equity. In the strictest sense, the only cash flow that an investor will receive from an equity investment in a publicly traded company is the dividend that will be paid on the stock. Actual dividend, however, are set by the managers of the firm and maybe much lower than the potential dividends. Okay, for many reasons that could have been paid out, right? Why? Managers are conservative and try to smooth out dividend. You don't want to surprise your equity investors. We will see in the future, in the next couple of slides. Managers like to hold on to cash to meet unforeseen future contingencies and investment opportunities. So there is a kind of a precautionary saving going on, and you want to grow your company to a certain degree, even if your company or industry is stagnant and slow growing. Okay, you have to find out some new growth potential, tap your new potential. So you don't want to spend the 100% of your available cash, right? When actual dividends are less than potential dividends, using a model that focuses only on dividend will understate the true value of the equity in a company. And so, could you show me visually? Let's look at KT&G, dividend versus EPS. Okay, dividend per share and EPS. So which is smoother, okay, is a question, and which is, lower, okay, which is, so ever since 1995, when it went public, and then until 2000, about 17, I show you the time series graph of dividend per share and earnings per share of KT&G, the tobacco and ginseng company. Hurt your health and help your health, right? 병 주고 약 주고. So you see the EPS is a green dot, and it has been growing faster than the dividend, okay, and fluctuating more than the dividend, okay. Sometimes when their business is tanking, is there, okay, EPS shrinks down, but it also gets up pretty soon, more volatile than dividend. Dividend is smoothed, okay. There's something called the dividend clientele theory, okay. What does that mean? Okay, dividend clientele. Different investors invest in different stocks, and there are some investors specifically looking for dividend payment. Okay, compare yourself, young blood investors, versus your grandpa and grandma. Okay, grandpa and grandma or old generation people in their later stage of their life cycle, they look for dividend payment because they are retired, and they don't have they have stable income called the pension, but they want more cash, stable income sources, and then they look for dividend paying stocks because the dividend can give them tabak like a stable cash flow to their account. So your grandpas and grandmas, old generation people, they tend to invest more in KT&G kind of stable companies, dividend paying companies, 배당주, right? 배당주 in Korean terminology. Okay, they form specific dividend clientele. Okay, and then you guys, younger generation guys, rarely think about KT&G. Okay, young blood go for tech stocks and don't look for dividend payouts, right? Older generations, why do they? Another reason for them to look for dividend paying stocks is because they are slower in clicking the sell button or buy button. Okay, it's a natural, what is it? Aging process. Okay, gets slower and then they are not good at timing the market usually. So cognitively they are slower, so they are not good at quickly buying and selling tech stocks. Instead, they resort to this dividend payment, tabak, paying dividend cash, right? Whereas you guys, young blood, are fast in timing and getting the information and buy and sell, right? So you don't usually invest in this kind of dividend paying stocks. So dividend clientele theory, okay, says that there are a specific group of investors who self-select into this kind of dividend-paying stocks versus tech stocks, right? And then what's the implication? Well, given that dividend clientele, if you are the CEO of KT&G, okay, what would you do for payout policy? Okay, you don't want to disappoint those grandpas and grandmas, and then those investors who look for this dividend payment, right? And stable dividend. Firms in certain industries have investor base that looks for high dividend payouts, and you don't want to disappoint them. So dividend is smoother, right? In the end, smooth dividend payment, quite expectable, even though your business situation shown by this in EPS, right, fluctuates a lot, you don't want to disappoint your dividend, the clientele, okay? That is why you want to be conservative. You don't want to pay 100% of your net income all the time, okay? Only a fraction. Even when your business is doing good, you don't increase your dividend drastically, okay? Because you know it's going to be fluctuating. You don't want to disappoint them in the future. So you want to manage your dividend level in a conservative manner, not to surprise your dividend your shareholders in the future. Okay, that's the idea. And then next slide, I show you a tech stock called Samsung Electronics. Okay, Korea's biggest stock. They pay very small amount of dividend because they have to reinvest a huge amount back into the semiconductor business. Why? Why don't they pay dividend rich? Many reasons. Memory chip semiconductor business, you have the side reading reference book, Chip War. Read it, okay, and you will learn how much serious this competition is. Is a semiconductor, HBM, this kind of businesses, the investment amount exponentially grows because of the Moore's law, right? The density of the transistors within a given semiconductor doubles every 2 years or something, exponentially grows, and then precision have to improve exponentially, and it's just a chicken game among small number of intensive competitors coming from Taiwan, TSMC, and then China, Changxin Memory, and then SMIC, and then Hynix and SK, what is that? And then Micron, all these guys, right? Dead or alive, or cutthroat competition goes on. So they cannot afford to pay dividends so much. So that's why their dividend is very, very low, but stable, okay? Compared to their fluctuation of net income, it's rather stable, very, very stable, okay? And POSCO, firms do not quickly cut dividends simply because their earnings is bad in the short run. Okay, it goes together with the the dividend clientele story. Okay, sometimes your business situation is very terrible and dip it, but if you anticipate, if your CEO has an insider information and you know that the business will recover soon, then you don't want to disappoint your shareholders by cutting your dividend. Just sustain it, okay? Sustain it. Otherwise, the dividend cut will work as a signal, okay? KEPCO, firms cut dividends when they foresee a really, really dismal prospect in the long run. So here is an example coming from KEPCO. KEPCO, their graph of net income or EPS was fluctuating, and it was hitting rock bottom, negative side, okay, for a long time. And the interesting thing is KEPCO, the electricity utility company of Korea, very stable business, but they smoothed out their dividend, but they cut their dividend in 2007. That worked as a huge signal, okay? Because the management foresees, has a better insider information. The fact that they cut the dividend works as a signal because there's that information asymmetry between outside investors and versus inside CEOs. And lo and behold, no wonder their net income was in the negative side for about 5 years. And then they started to pay dividend back again in 2013. And that worked as another signal, this time positive signal. And that tells us that, the CEO knows that the prospect is good. From now on, party time, pay out dividend. Otherwise, okay, why? If the management perceived that the net income will plunge back again to the negative side, they would not restart the dividend because they don't want to disappoint the shareholders again in the future. So the fact that the CEOs started to pay the dividend back again works as a positive signal. Okay, dividend works as a signal. Google, Alphabet, tech stock reinvest 100% of their net income for growth. You see that net income, EPS, dividend per share, zero. Okay, until 2016. SK Hynix, cyclical industry and dividend payout, memory chip industries. Well, you see this drastical movement, right, of net income, and then the dividend. They seldom pay dividend. 2025, it's going to be fun to watch. Okay, let's do it in your homework. Anyway, so that's about it for dividend discount model. Very primitive form of equity cash flow and DCF model. So I hope you enjoyed it. And then dividend clientele story and dividend signaling model. So I hope you had a good time understanding it. Thank you for watching. Bye bye.